all income must be treated equally for tax purposes. This includes earned as well as unearned income. It includes active and passive incomes. They must all contribute to the total annual taxable income. Income must be calculated basically as the total of all wages and gifts, including inheritance, as well as royalties, dividends. It also includes realized capital gains and any withdrawn profits. Commissions, bonuses are also included, as well as allowances, grants, and subsidies. Even people's pensions or childcare payments. Interest and rents, and any loans received, which we'll get to in a moment. Loans are an interesting one. There must be no categories of income counted at different tax rates. If a person receives something considered a liquid asset, then it must contribute to annual income for tax purposes. Illiquid assets, such as unrealized capital gains and real estate, contribute to total wealth calculations, which is something we will discuss later. Now, on the topic of loans, we want to have a situation where even personal loans must count towards income, whereas business loans cannot be used for personal expenses or for any personal benefit in any way. For lines of credit, the actual amount withdrawn or borrowed within each calendar year counts towards taxable income. Including borrowed money closes a loophole that wealthy people use to avoid paying income tax. The way this works is that because interest rates are lower than the tax rates that people in upper income brackets will pay, paying interest on a personal loan is much cheaper than paying the upper band of this income tax. So wealthy people borrow using their assets as security, and since most assets go up in value, they can take out additional loans to then pay off their previous loans. This method of tax avoidance redirects money from public services, benefiting everyone, into private profit for banks that benefit only their wealthy shareholders. Making personal loans contribute towards income will stop this practice. The borrowers that do so will have to pay the interest as well as their taxes. This will make the practice more expensive than simply paying their income taxes like everybody else should. The maximum annual income must be fixed as a ratio of the minimum annual income. The minimum income must be calculated based on working full-time at the minimum wage. If a country does not have a minimum income, then it will need to establish one. The only way for the maximum income to increase must be if the minimum income increases first. This establishes an incentive for wealthy people to encourage increasing the minimum wage. Using a 1:100 ratio as a starting example, if the minimum annual income was $15,000, then the maximum annual income would be 1.5 million. However, this ratio is perhaps too high for maintaining a stable and harmonious society in the long term. Using a smaller ratio of, let's say, 1:50, that maximum income of 1.5 million would translate to a minimum annual income of 30,000. This is better, but the income inequality gap will still produce resentment, massive wealth inequality, and its associated societal problems. So, an ideal ratio for a good society in the long term might be something around 1:10 or 1:20 at the most. So let's use a ratio of 1:15 as an example. A minimum annual income of 30,000 would mean that the maximum annual income would be 450,000. The aim is to provide a broad range of incomes between what must be a minimum living wage, that's very important, and rewarding people for exceptional effort or their exceptional skills. Society needs to provide an incentive for people performing hard, dangerous, or even disgusting work. Or if they want to undertake years of study to gain a qualification and be qualified for a very important role in society to help others. Or if they want to engage in entrepreneurial risk. Or if they have exceptional knowledge or skills. All of these circumstances are ones in which individuals need to be rewarded for their contributions to society. Extremely high pay ratios and paying everyone the same amount are both socially destabilizing options. There needs to be some inequality or a moderate range between the minimum and maximum income. One benefit of defining the minimum and maximum income as a ratio is that it removes the need for political intervention or legislation. The ratio must be established in the Constitution so that wealthy interests cannot capture government and change a law to benefit themselves. Establishing a fixed ratio instead motivates the highest earners in society to increase the incomes of the lowest earners. So they will try to increase the minimum wage, is the idea. And this is because the highest earners can earn a multiple of those gains for the minimum income. Using the 1 to 15 ratio, increasing the minimum annual income by 1,000 means that the maximum income can increase by 15,000. The actual ratio must be decided democratically after hearing from independent and interdisciplinary experts informed by empirical research. Whatever the minimum income amount, it must enable someone with one dependent to earn a basic living wage, working 80% of full time. This provides at least 20% of the workday to pursue other interests. For example, people on minimum wage could choose to use that time to earn more than just a basic living wage. Alternatively, people could use the time to study or train for a better paying job. They could spend time with friends and family, or just relax and pursue personal interests. These are the kinds of benefits that a good society is supposed to provide its citizens. Societies that cannot provide full-time working citizens with a comfortable life beyond merely surviving are failed societies. Citizens should allow these societies to collapse so that they can rebuild a better economic system. Everyone should have the opportunity to earn enough to have a good life, even those in the lowest paid jobs in society. People should not have to work to exhaustion and burnout just to exist. A minimum full-time income must provide for a life worth living. Income tax rates must be linked to the minimum and maximum income levels. The minimum income must automatically rise and fall with inflation and deflation if that happens. When the minimum income changes, then the currency amount defining each bracket must change automatically. Changing tax brackets must not depend on political decision-making. If tax brackets are defined as fixed currency amounts and do not change automatically, then a greater proportion of income is pushed into higher tax brackets over time. Inflation erodes purchasing power, so real incomes do not increase. The combination of inflation and static income tax brackets means that higher effective tax rates will be paid each year and people will experience lower standard of living. The tax brackets, therefore, must automatically adjust. Tax brackets must be also more granular than they are now, so that the rates increase gradually without big jumps in percentages. For example, there could be 101 income tax brackets with the lowest bracket set at 0%, and each bracket would then increase by 1% for the remaining 100 brackets. The marginal rate for each bracket will only apply to the income that falls within that bracket, as happens with current progressive tax systems. Any income then over the maximum level would be taxed at 100%. However, this top tax bracket would apply to very few people. The aim of having so many tax brackets is to remove disincentives for jumping into higher tax brackets. In current systems, people jumping the large thresholds into the next tax bracket may not see as much benefit for their pay rises if it means suddenly paying a lot of additional taxes on that pay rise. However, with more granular increases, this problem decreases because pay rises are only gradually taxed more. A prior example uses an income ratio of 1 to 15 with a minimum annual income of $30,000 and a maximum income of $450,000. We can evaluate what 101 tax brackets would look like with this example. Most tax brackets would span 4,242. This is calculated as the difference between the maximum and minimum incomes divided by 99. Why 99? The difference is divided by 99 because the bottom bracket is 0% for everything below the minimum income, and the top bracket of 100% applies to income above the maximum. So the 101 brackets minus the top and bottom brackets equals 99 brackets. And this is what we divide the income difference between the maximum and minimum incomes, and that gives us 4,242. All income within the first tax bracket, so everything below 30,000, attracts a 0% tax rate. Nobody pays any tax on this first amount of their income. Someone earning 34,242, so that's the 30,000 plus the first bracket amount, would be taxed 1% on that amount above 30,000. So they would pay $42 in annual taxes. Someone with an annual income of $38,484 would pay this amount plus 2% on their next $4,242. So their total taxable income, or their total amount payable, would be $127. Each additional $4,242 earned is taxed at an additional 1%. But the higher percentages only apply to income that falls in each successive bracket. Someone earning the maximum of $450,000 would pay 99% on their last bracket of $4,242, and anything over $450,000 would be taxed at 100%. So that establishes the cap of $450,000, or whatever currency you're using. The effective or cumulative tax rate of someone earning $450,000 would be about 47%. This means a maximum after-tax take-home pay of $237,879. This is based on the example of a 1:15 income ratio with a minimum full-time income of $30,000. Changing the ratio or the minimum income changes all the other calculations. So this was just an example.